I'm ranking 12 of the most well-known dividend ETFs, from S tier, the true standouts, all the way down to F tier, the ones you should seriously reconsider holding. And yes, a few popular favorites won't land very high. This ranking isn't based on hype or personal bias. I evaluated dividend yield, growth, expense ratios, tax efficiency, and long-term total return, strictly real data. So, if you already own dividend ETFs, or you're considering buying one, this is important. By the end of the video, you'll know which funds genuinely generate income, and which ones only appear attractive while quietly dragging down your portfolio. Here's how the ranking works. I'm grading 12 dividend ETFs across 5 major categories: current dividend yield, future dividend growth, expense ratio because fees reduce returns, tax efficiency so you keep more income, and total return, since real wealth comes from both dividends and price appreciation. Each ETF is placed into one of 6 tiers. S tier is elite. A tier is strong with minor weaknesses. B tier is dependable. C tier is average. D tier has notable issues. And F tier? Best avoided. By the end, you'll see the full list and understand exactly why each fund ended up where it did. Quick disclaimer. This reflects my interpretation of the data and is for educational purposes only, not financial advice. I'm not a licensed financial advisor. Your goals and risk tolerance are unique, so always do your own research and consult a qualified professional before investing. Some of you will disagree with the rankings, and that's okay. Share your reasoning in the comments. Starting at the top, S tier. These are the standout funds that combine dependable income, solid growth, low costs, and strong long-term results. S tier number 1, SCHD, Schwab U.S. Dividend Equity, ETF. This is often considered the benchmark for dividend growth investors. The yield is around 3.6%. But the real strength is dividend growth, roughly 12% annually over the past decade, faster than most wage increases. The expense ratio is just 0.06%, and the fund emphasizes profitable companies with long dividend records and healthy cash flow. Over time, SCHD has matched or even exceeded the broader market while delivering higher income, and its qualified dividends are tax efficient. There isn't a meaningful drawback here. SCHD clearly belongs in S tier. S tier number 2, VTI, Vanguard Total, Stock Market ETF. The yield is lower at roughly 1.4%, but S tier isn't only about yield, it's about total return. VTI tracks the entire U.S. stock market, holding thousands of companies with an ultra-low 0.03% expense ratio. Dividends grow steadily, and long-term compounding has historically outperformed many alternative strategies. Reinvested payouts transform modest income into substantial growth. For simplicity, diversification, and consistent wealth building, VTI earns a spot in S tier. Now we move into A tier, outstanding ETFs, with 1 or 2 minor limitations that keep them just below elite status. A tier number 1, VOO, Vanguard S and P 500 ETF. Think of VOO as closely related to VTI. Instead of owning the entire market, it tracks the 500 largest U.S. companies. The yield is roughly 1.3%, and the expense ratio is just 0.03%, the same as VTI. Long-term returns are also very similar. So why not S tier? Diversification. VTI holds thousands of stocks, while VOO holds 500. The gap isn't huge, but it's there. If you already own VOO, there's no urgent need to switch. But if starting fresh, I'd lean toward VTI. VOO earns a solid A-tier placement. A tier number 2, DGRO, iShares Core Dividend Growth ETF. DGRO emphasizes dividend growth like SCHD, but uses a broader portfolio of around 400 holdings instead of a more concentrated approach. The yield is about 2.4%, and the expense ratio sits at 0.08%. Dividend growth has been consistent, though not as strong as SCHD's long-term record. The added diversification provides stability, but SCHD's superior growth gives it the advantage. DGRO is an excellent fund, just not the category leader. A tier number 3, VYM, Vanguard High Dividend Yield, ETF. VYM focuses on higher income today, yielding roughly 2.8% across about 500 holdings with a 0.06% fee. The trade-off is slower dividend growth and occasional exposure to value traps, companies offering high yields but limited growth potential. Long-term total returns have trailed stronger dividend growth funds. It delivers dependable income, but with less momentum over time. VYM fits comfortably in the A tier. Now we move into B tier. These funds can work, but they come with clear compromises you need to understand. B tier number 1, JEPI, JP Morgan Equity Premium Income, ETF. The yield is around 7 to 8%, which sounds very attractive. The fund produces income by selling covered call options on its holdings. The downside is, those options limit upside potential. When markets surge, JEPI tends to trail because part of the gains are exchanged for income. There's also a tax concern. Much of the payout is treated as ordinary income rather than qualified dividends, making it less efficient in taxable accounts. For retirees seeking stable cash flow, JEPI can be useful. For long-term growth, the capped upside keeps it out of higher tiers. B tier number 2, JEPQ, JP Morgan Nasdaq Equity Premium Income ETF. This is basically the technology-focused counterpart to JEPI. Yields can reach 9 to 10%, but the same compromises apply: limited upside and tax inefficiency. You're giving up future growth for higher income today. If immediate income is the priority, it can work. If you're still building wealth, stronger options are available. B tier number 3, SCHD Schwab, U.S. Large Cap Growth ETF. Not truly a dividend ETF, but often combined with dividend strategies. The yield is below 0.5%, effectively minimal. However, total returns have been strong due to large growth companies. The trade-off is volatility, strong gains in bull markets, but sharper declines during corrections. Helpful as a growth addition, but weak as a pure income holding. That's why all three fit squarely into B tier. Now we move into C and D tier, funds that come with significant structural weaknesses. C tier number 1, QYLD, Global X Nasdaq 100 Covered, Call ETF. The yield looks very appealing, often around 10 to 12%. The fund creates income by selling covered calls across the entire Nasdaq 100. But that income has a cost, limited upside. Over long stretches, the share price tends to drift downward, meaning you receive cash while your principal gradually declines. That's not true wealth creation, it's slow liquidation. The only sensible use case is someone who needs maximum income immediately and doesn't care about growth. For most investors, it fits in C tier. D tier number 1, SPHD, Invesco S and P 500 High Dividend Low Volatility, ETF. On paper, it sounds attractive, higher yield with lower volatility. But many holdings are companies whose prices have already struggled. Dividend growth is weak, performance trails the broader market, and the 0.30% expense ratio is expensive for a passive strategy. Compared to stronger dividend ETFs, it consistently falls short. D tier number 2, DIV, Global X, Super Dividend US ETF. This fund targets the highest yields available, which often means lower quality businesses. Dividends have been reduced multiple times, price appreciation is limited, and the 0.45% expense ratio is very high. The outcome is poor total return and a textbook yield trap. Best avoided. Finally, F tier. Only one fund ends up here. RYLD, Global X. Russell 2000 covered call ETF. It resembles QYLD, but uses small cap stocks, which increases the risk. The yield is around 10 to 11%, but the strategy limits upside during the occasional strong rallies small caps have. Over time, total returns have been weak, dividends fluctuate, and the share price trends downward. That's not true income. It's gradual loss of capital. There's really no clear situation where RYLD fits well. Not for younger investors, not for retirees, not for anyone. F tier, avoid it.